If the past few days have shown us anything, it's how quickly oil markets can move when geopolitics takes over. The challenge for investors is separating the short term noise from the bigger opportunity. To help us sift through the noise, we have Josef Schachter from the Schachter Energy Report to join us on our podcast today. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you're an investor or just want to learn more about the topic, this is the podcast for you. So, Joseph, welcome to our podcast. Please tell us and our audience a little bit about yourself and the Schachter Report.
My pleasure, Nitesh. Glad to be with you. I've been in the following the oil and gas industry for quite a few decades. I got in the business in '72, so I was there for the '74 to '81 major cycle, and then of course that was an investing cycle, and price of oil went from sub 3 to 36. And at the margin, Japan was the new entrant. That when supply and demand was tight at the beginning of the cycle, they came in and that drove it up. And of course, we had the '73 war, founding of OPEC, and then, of course, the Shah of Iran was deposed at the end of that cycle, and we went up to 36. During that window, oil went up 12 times, and the index for energy stocks in Canada went up 15 times. So a very rewarding cycle. Didn't mean there weren't nasty corrections along the way, but it was a fabulous cycle. We then went into a trading market until 1999, and then China came in as the new entrant to capitalism under communist umbrella. They were consuming 3.5 million barrels. And by the end of the time, when we got to 2008, when we were at 147, a nominal for the WTI, they were consuming 13, 14 million. So we think the third cycle started in 2020. So I believe that when you have those investing cycles, you want to be there. So we created the Schachter Energy Report for Canadian individual investors. There was a lot of when you had the bad times, the brokerage industry cuts back on research and analysts are gone. So we created a product for individual investors. And what we do in ours is it's not the highly technical reports that you see in institutional reports. Retail seems to want to know simply, why do you like the story? At what level is it a good buy? Where do you think it's going to go during the cycle? And keep us up with a balance of evidence. Things are doing well, things are not, and the things that are not are insider selling or too much debt or drilling success is not good. So you want to know all of those things, and we do that for the individual investor. We started the business in 2017. I came from the buy side and the sell side. I was a market strategist, chief market strategist at a brokerage firm called Richardson Greenshields that even had a London office going back before Royal Bank bought us. And then I started the firm right after that when the Royal Bank was purchased. So it's been a great run. And Royal Bank bought us out in '96. I started my own firm, worked with institutions, worked with the flow through shares, which was a tax efficient way for people to invest in the resource sector. And I believe this cycle, which started in 2020, is for all commodities. And we've seen it in the foods, we've seen it in copper, we've, of course, seen it in precious metals, uranium. And so I think individual investors or investors, institutional and individual, should own a reasonable portion of their portfolio in resources. The question is something to sit down with your investment advisor to see what's appropriate.
Excellent. Thanks so much for that introduction, and it's great to have you on the show, given the wealth of your knowledge in this area. And I can clearly say that a lot of our audience will be interested in the commodity market. So, what a time to be, sitting down and discussing this with you. So, let's talk about the sort of the here and now, right? We're just over 3 weeks into the Iranian conflict, Iranian war. Um, and the impact on commodity markets seems to have intensified as the weeks have gone on. In particular, in the last few days, the markets have been whipsawed. Oil up sharply, then down just as quickly, based on all the headlines. I mean, just taken today, right? Oil prices in the morning, sort of London time, up close to 10% on the fears of escalation in the war. If as Trump was, it looked like the deadline for Trump's ultimatum was coming near, and then we had the news headline that the discussions are going well, and oil prices gave up all of those gains. Um, but what's really driving all the volatility? How do we separate the headlines versus the reality on the ground?
Well, right now we're adequately supplied with oil between the company inventories, commercial inventories, the SPRs, the release of the SPRs, but the strategic petroleum reserves, the giveaway of allowing Russia to sell for 30 days to India and China with no sanctions, and of course they're getting much higher prices because of that. We're now seeing the same thing going for the Iranians. Venezuelan crude is coming on. The Secretary of Energy said that they're now producing 1.2 million. Before the Americans went after them, they were about 900. They went down to 300. They're now 1.2, and they're talking that number could be 1.5 by the end of this year. So we're adequately supplied for 2 to 3 more weeks. Once you eat into the shadow fleets of Russia, Iran, and the release of the SPRs, so sometime in late April is when the we're going to be in a quandary because the daily available supply may only be 90 million barrels per day. Consumption is probably 106 million barrels per day. That's when we'll probably see the pinch point where prices could escalate. So our view has been the longer the war, the higher the price. The longer the war, at some point, you get to the point where the market has used up any available supply, and then price has to be the adjudicator and the balancer of where things are. And so I think that this talk today by the president that there might be some talk with some leadership. Nobody knows who. Is it the Omanis in between? And the question, there's three. Will they give up their nuclear materials? They talk about having, potentially 1,000 pounds of 60% uranium, which could be good for dirty bombs. And 2 weeks they could upgrade that to 90, which is nuclear. They have ballistic missiles that are gone twice as far. They thought they could only go, 1,200 miles. Now they can go 2,500 miles, as we saw with the attack on Diego Garcia. If they could get that to 5,000, in other words, another doubling, they could hit anywhere in America. But right now, that 2,500 means all of the European major cities are at risk, and most of them do not have, military protection. The Patriot or the SAD or THAAD or other missiles developed by Europe. So we're at a quandary here. Will the new regime agree to, give up their nuclear weapons? Will they give up their ballistic missile programs and stop it? Will they agree not to be terrorist, supporters in around the world? So until we know the answers to that, we have a 5-day window here. If, as you were mentioning earlier, it was 48 hours going back, yet from Sunday. Monday morning, President Trump threw us for another loop, trying to do it. Some of the cynics are out there saying it just gives him a week to get his Marines in place so that they can take Carg Island. Others cynically saying they need more munitions, they need more, everything in the area. So 5 days allows them to do it. In the meantime, it gives the Iranians 5 days to replenish and put their drones and ballistic missiles ready for the next attack. In the meantime, there's still attacks going on. They're still going after Israel. They're still going after Saudi refineries. So the only thing that's out of reach of right now for the 5-day window is power plants, because if you destroy the power plants in Iran, you effectively shut the lights on the country, just like what's going on in Cuba. And that really would be horrendous for the people and the population of Iran. So we have a 5-day window to see if there's real talks going on. If it isn't, and Trump gets frustrated in day 3 or day 4, saying it's not going anywhere, then we could be back to full war. But I like the cynical view that it might be the Americans trying to get more military in the area, so that they can then threaten Iran, saying if you don't, then we have this Carg Island grab. If we take them and say you're not selling any oil, but in the meantime, as you said this morning, prices went up. And then by the after, like, when we came in this morning at 7:30 my time, opening of the stock market here in Alberta, we were up $12 for the price of oil. Now we're up the price of oil is maybe 8. So it swings around a lot. But I think people should be thinking simply the longer the war, the higher the potential price for oil. We've already gone up. If from on a liter basis, we were $1.30 a liter, and now we're sitting at $1.70 a liter. So we've already seen at the pump here in Alberta a price increase, and I would assume the same thing has happened in London and wherever your listeners are, where there's 20 to 30% increase in product already. Diesel's gone up even more, and other product prices even more. The equivalent from a Brent value would be over $200 a barrel, even though we might be sitting in the 90s right now for Brent's official nominal price.
Yeah, I mean the impact is quite profound, and it's happened over a very short period of time. Um, I guess you talked a little bit about some of the offsets. The SPR release, the Strategic Petroleum Reserve release. Um, how much impact does that really have? I mean, how quickly can you get oil out of the reserve to net off the daily barrels lost, right? Essentially, is that quick, or are we hurting at the moment?
It's a great press announcement, but when you
Yep.
talk to the companies that are gonna take the oil, they have to have the grade of oil that they want in the right place, so the logistics are becoming a challenge. In the United States, they're saying for every barrel you take out, you gotta give us 1.2 back a year from now. That was from the Secretary of Energy just a few minutes ago, and so the reality is it's not gonna make an immediate solution. Where there's gonna be an immediate solution is the shadow fleets of, Russia and Iran, that are now available for sale, and the small incremental amount that's coming from Venezuela. Commercial inventories in the States are are in decent shape. Worldwide, globally, we're at 90 days of, demand, for, inventories, historically range 88 to 92. When we had the COVID situation, we went up to 120 days, and then you go to the 2008 when we were at 147, we only had 79 days. So if we start coming down from the 90 to 88, 87, 86, I think that's what people should be watching is the announcement of where global inventories are relative to days of consumption. Now, the wild card is consumption. Does consumption come down? Because as the price goes up, the people, lower it. And the other point is you hear the longer the issue we could see, and we've seen some people say 175, 180 could happen for Brent. And if that happened, would that be a global recession, which of course would hit demand? So there's so many moving pieces to this that you get up in the morning and you say, okay, what's going on now? And you check the price of oil, and then you say, okay, what did Trump say overnight? And then of course we find out this morning that he did.
Yeah. So I guess you make a great point there on demand destruction, right? I think the immediate effect of all of this is a lot of planes are being grounded, especially those heading to the Middle East. But as time progresses, there's more and more demand that can come off the table as the energy prices increase. I think most consumers around the world are protected from to an extent because utility bills etc have price caps that have to be maintained for a short period of time before they can be moved up. um but yeah, recession risk is there, and I guess the markets are worried, right? Those rate cuts that markets had been pricing in pretty much all off the table. People looking for rate increases with inflationary pressure. So where do you sit on that? I mean, are you a believer in this kind of stagflationary view of the world where prices go up and the economy slows down?
I think definitely we're seeing that. You saw the fourth quarter number for US GDP come down. We're seeing so many numbers from Europe that are just, kind of sputtering around the neutral mark. We're seeing weakness in some of the Asian countries. So again, the longer this lasts, and the higher the price of oil, the more risk we have for a global recession. Um, the inflation, we've been all hoping for, the 2% target of central banks. I think we just saw data from, before this oil spike where we were, talking, 0.5, point 0.6 for the US for the PCE deflator. I think we're looking at potentially, 4 or 5% inflation right across the board by, 3, 4 months from now. And that number would spook the central banks to say, okay, we can't lower rates. And it'll be interesting to see which central bank, if any, decides to be the first to raise interest rates. And I think, the Federal Reserve in the States is really in a difficult position. You saw the way the market reacted when, they didn't get the answers they wanted. The market fell that day. So I think that we should be watching the inflation data, and I'd be watching food inflation as well. Remember, coming out of the Persian Gulf is urea, is sulfur. The fertilizer group is, and planting should be starting soon across the world in the northern hemispheres. And if you don't have, or if the cost of fertilizer is so high, farmers won't buy as much, which means the yields will be lower, which means the price of, the amount of food that comes out of it will be less, which means the price of food goes up. And as that goes through the food chain and into the time we get to the grocery store, that is really where the problem is. Yes, it's energy, but then, other things are impacted as well. And it takes time for that to go through the price points and to the time we get it as consumers.
That's a great point. I mean, Joseph, we brought you on to talk about energy, but this is clearly broader than energy, and clearly commodities are a good inflation hedge, especially against surprise inflation, which I guess we can put the current events into that category. Um, you talked about an energy super cycle. Is this broader than an energy super cycle? Is this a broad commodity super cycle, in your opinion?
Yeah, I believe it is for all commodities because there was underinvestment for so long in the commodity areas. And as you get more people buying, and the theory that we're going with is in the 1970 cycle, it was Japan that came in as a new entrant. In the 99 to '08, it was China. This case, it's the third world. Where's copper going to come from? Where's more lithium? Where's more, all the things that we want, aluminum, copper, nickel, all those things, rare earths. Where is it going to come from? It'll be coming from Africa, South America, parts of Asia. And many of those countries, are going to want a good rate of return. They're going to want for the royalty income coming in. They're going to want to have, there's going to have to be roads built. There's going to be a great consumption of more energy. All of that is going to be part of the story. And it takes time to build new mines. It takes time for the logistics to be built, and the costs are very high. So the economic return for those countries have to be there, and most importantly, for the individual people working there. Many of those countries, the people were in the areas do not have running water in their homes. They don't have electricity. They're going to want that if they're going to support the expansion and approval for growth in their areas. So we think that the third world is where the demand growth is going to come. So if you look at the 106 million or so this year for consumption, we think it's going to be 110 to 112 by the beginning of the next decade. So there's your growth. But the OECD will have less because of EVs, because of all the things we're doing. That way, renewables, all the things that you can do in an industrial world, which you cannot do in the in the emerging world. So that's the emerging world will be where the growth is. You will see probably declines, moderate declines, 2, 3 million barrels a day coming from the OECD countries, and that is where the story is for us. And we think that whenever you hear about new copper mines being approved in Peru or Chile or whatever, you're talking about more energy consumption as a result of that because they don't have their own domestic energy. And Mongolia, Africa, Congo, of course, rare earths and copper. So I think that we're looking at a cycle that could last a longer time than the other two cycles simply because the places where we're going to have to build those new mines to bring on the product we need just takes longer, very costly. They don't have infrastructure. They don't have electricity to the places where you want it. All of that means more time, more money, more energy consumption.
That's great. I mean, I'm glad you brought up the the story of the metals that are sort of powering new energy supply. I guess. Um, do you think today's events are likely to accelerate that sort of policy driven inertia to look for alternative sources of energy. Because right now we are living in a world of heightened uncertainty around energy security. Do any of the alternatives provide meaningful solutions there? And do you think today's events are possibly going to be a catalyst for moving more in that direction?
Well, if you're looking at renewable solar, tidal, some of those make sense, but the numbers are so small, it really doesn't. The big areas for it would be uranium for small modular reactors. Nuclear plants are being considered right around the world. Ones that were being closed are being not so closed. In Canada, we're rebuilding some of the ones that are getting pretty old and making them more modern, and that's going to be part of it. But I think natural gas is really the fuel that's going to transition us for the next 2, 3, 4 decades. That's why LNG is so important. That's why the Qatar shutdown is very important. And the price of natural gas, the TTF price has gone nuts because of the shortage that Europe is. Europe is trying to get as many cargoes coming out of the U.S. as they can. Canada, our LNG Canada project that came on very slowly. Was supposed to go with 2 trains to 2 BCF, one per train, and now it's running full out. Asia's knocking on the door like crazy, build the second phase for another 2 BCF. Canada, potentially by the end of the decade, has projects in the queue waiting for FIDs and waiting for, federal government approval, where we could have 6 BCF. Take that on a base of 18. Number 1, on the 18, you gotta replace declines, plus you got the growth of 6. That's a pretty good growth rate for an industry between now and the end of the decade, and that's why Canada stands out as a great place to invest. Let me put Canada in context. The United States, between oil, 13.7, and liquids, renewables, natural gas liquids is another 10, so 23.7. Right from there, the next one is Saudi Arabia, around 10.2, 10.3. Then you go to Russia at, 9.4, 9.5, and then you go to Canada at 6.1 million barrels a day, and then just below us is China at 4.2. So we're the 4th largest producer of energy with the capacity to add 2 to 3 million more barrels if we had government approvals and we had built the infrastructure pipelines to the West Coast. And that's part of the whole story with the Carney government getting decisions going forward. The demand is there. We're a resource country. We're like Australia. We have grain, we have minerals, we have energy, of course, we have forest products, and the biggest export revenue source for Canada is energy, and second is minerals, precious metals, and base metals, and then so we have an opportunity to create a bigger pie for Canada, and the government of Canada is now interested in doing that. Even the Quebec government, which has been very anti the fossil fuel industry, they import from Saudi Arabia, so but they're against Canadian oil, which, you wonder what the oxymoron of that one. But the bottom line is everybody seems to realize, number 1, we are in a world where there's a shortage of supply. The extravagances of cheap energy, cheap food, cheap uranium are gone, and I think everybody now realizes security of supply is important. And, what are we gonna do? Send the Mounties? It's not like we can send the Marines, so Canada's considered a very safe place to invest in, simply because, we're nice, we smile, we say thank you, and so it's an interesting, situation for Canada, and I think, investors around the world should be looking at Canada, when it's not gonna be for the long term, But for the next 5 to 10 years, maybe closer to 10, the Canadian investment industry from resource base is very attractive.
Excellent. I mean, yeah, I mean, it's good that we have the likes of Canada and other parts of North America to help fill the void. That's being left here. With it to fill that supply gap. As you say, it takes time, right? It takes time to build the infrastructure. Um, Europe's natural gas demands are almost immediate, but we can't get the cargoes out fast enough from Canada and the US. But I'm glad you've turned the conversation to Canada. Where else are you seeing growth? I mean, obviously Europe and Asia is a clear place for where there is that energy deficit, and we are clear. Sources of new demand from Canada. But where else is demand increasing?
Well, the cargoes that are coming for LNG Canada are mostly going to Asia because the distance from Western Canada to those countries is shorter than the distance that comes from the Gulf of America or Gulf of Mexico, depending upon who's talking. Um, and so the reality is we are able to ship to Japan, to South Korea, to Vietnam, to Thailand, to China, and so more and more of those Asian countries are knocking on the door, and they want oil. So the TMX pipeline is helping. On natural gas, we have the Coastal Gas and the LNG Canada. We have Enbridge building a facility. We have others working on, Pembina Pipeline working on a small, LNG plant. I think that we have an enviable position to do that. Our basins are not as drilled up as the United States. So our Montney and Duvernay has more capacity than the Permian does. And so the Permian has a lot of people are saying they're drilling, let's say before March 1st, they were drilling tier one and tier two inventory. In Canada, we're still drilling tier one inventory. We've got a long life to go before we go to tier two. Now, price makes a difference. If the price of oil is $60 WTI, remember the Canadian dollar trades at 1.37 times that. So our price is higher because of weak Canadian dollar. So the industry here has lots of cash flow coming in to grow their business, but they need takeaway capacity. We still have room in TMX for oil. Those volumes are filling up. We have the LNG facility now running. That's going to take 2 BCF a day. And the data center business is going to be a big one for Alberta and other parts of Canada where you have cheap energy or cheap electricity, and natural gas fired is going to be. And our provincial premier is saying, if you want to open up a data center in the province, find your own source of power and build your own power. And so a lot of companies are now talking to the natural gas companies and saying, look, can we build a data center close to you? We'll pay you, a price, off US dollar NYMEX better than ACO. So NYMEX is trading just under $3 today US. ACO trades at $1.80 Canadian. So if we can, a company can get close to that in US dollars, multiply that by the Canadian dollar, that becomes a very attractive price. And so we're having a lot of discussions. And one company, Pine Cliff, has already got a contract to do that. And we've heard from many, many companies that they're working and negotiating for larger deals, where the data center would be built very close to the source of supply, being the natural gas, and then the pricing would be much more attractive than the ACO price, which is a landlocked price because of not having the ability to move it to market. Just think of, what's the price in the UK for natural gas? Compare that to Asia, which is less, and then compare it to the US NYMEX price, and then compare it to ACO. You can just see, where you have a shortage of natural gas. And of course, you had a pretty harsh winter, so you drew down your storage a lot in Europe. You've got to refill for the next winter, and that's the job you're going to be doing. And with not getting cargoes from Qatar and needing, you're going to be buying a lot of cargoes from the U.S. And Asia is going to be buying a lot of cargoes from Canada and the U.S. as well. So it's the longer the war goes on, the more restricted, natural gas is from the Middle East. The higher the prices are going to be, and less ability to fill, by November 1st, which is the fill season. Then you go into the drawdown season. So we're going to be watching that closely to see how quickly storage gets filled in time to meet the winter demand from 26-27 winter.
Yeah, it's quite a challenge. And as you say, the longer the war goes on, the deeper the challenge, really. So, why don't we talk a little bit about evaluations of companies in the oil and gas space? I mean, how do you think, as you look at Canadian companies primarily, how are they faring in this environment? Are their valuations looking rich, or do they look somewhat underpriced given all the risks that there are out there for the energy markets and the potential demand for their product?
Yeah, if you take where stocks were in April of 2025 when the tariff wars, were started by President Trump, the price of oil, if you remember, went down to $54. Companies, a lot of stocks have doubled or tripled. But what we look at is two measures that we cover. One of them is reserve value. So there's the conservative value that the banks lend against called the approved, developed, producing reserves. Then you have proven reserves, and then you have 2P, which is proven plus probable. Right now, many companies are trading at their PDP or just above it. So between that and 2P, you could have a double or a triple. But also, if you take a higher price longer term from that, $54 that we were in April of 25, and we have, let's say, an average price in 28, 29 of $80, post the war ending, then that's going to mean a big increase in the reserve value. Companies will then have cash flow to drill and bring on more reserves. That'll increase it. So we think there's still five baggers ahead of us on the PDP side. The other one is price to cash flow. Many companies are trading at 2 and 3 times cash flow. And historically, at the top of cycles, they've traded at 8 to 10 times cash flow. So right now, we're at the lower end. And of course, if you have higher commodity prices and higher production, that just adds to those numbers. So if you look at a golf analogy, I would say we're in the third hole of, and there's still 15 to go. So we're still, we've had a good lift, but use corrections to be buyers. So our approach is we're in a super cycle. We got people in 2020. We got them in during the correction of April of 25. We think there'll be another correction once you get the war over. That'll give another opportunity to be buying. We think natural gas stocks are cheaper than oil stocks, but we think that the correction will give buying opportunities in the oily names as well. And you want to be using any corrections. And if you look at any stock you like, be it in Europe, be it in the United States, pull out the charts from 1999 to 2010 and look at them, and you'll see that there were many of them were 5 and 10 baggers during that time, but there were corrections along the way. What you want to do as an investor is, number one, have investments in the sector. And if you want to add to them, use those corrections to add to your positions. If you're traders, you could do a different, more aggressive approach in and out. I'm an investor, and what I do is I just add to positions that I like because I think before the cycle is over, Canadian names will have a lot of international interest, and American companies and European companies will come back into the country. That's what happens normally for resource countries, like Australia or Canada. When the cycle is bad, they run away, and the local companies buy it out, and at low prices. And then when there's a shortage of supply, and they want to be in the country because they see opportunity, then they come in and they buy them out. Just take into account Ovintiv. They bought out from Paramount. They took out New Vista. We had a private equity company from the States take out Kuwaitno. So there's a lot of activity already happening, and we think this is just the beginning of a many, many year consolidation as bigger players come in, consolidate the place, like you're seeing in the United States in the Permian. The big boys are taking out everybody. ExxonMobil, everyone's taking out, and you're seeing announcements almost on a regular basis now. I think we're going to see more of that. And I think we're going to see more international players come into North America simply because of the security supply issue that's been very critically shown by what's going on in the Middle East right now.
Wow, excellent. And so, as we sort of wrap up, what do you think is the biggest thing that markets are underestimating at this stage of the conflict?
Well, I think that they don't seem to they seem to think that there's, um, an adequate supply of the oil. There was this talk months ago of 4 million barrels of excess capacity in the world. I think that's blown away as nonsense. The reality is we just like we saw with gold, the demand was so strong and, that the price just went up, and it was central bank buying, it was individual buying, it was corporate buying, and even, you get a day today with a big correction, people still want to hold that resource. Uranium, same thing, you're gonna see movement. Copper, you're gonna see it. So I think people need to have patience, use any dips, when they settle down to be buyers. Canadian stocks, many of them are yielding 4 to 6%. So you get a nice dividend yield, but more than you can get in the bank while you're waiting. And if we're right and the multiples expand and the price settles down in the 80s and 90s, which is what it's going to be needed at the end of the decade for companies to have the cash flow to reinvest in the business and add more resource production, that's going to be a very enviable one. And again, just go back to your favorite names from that 99 to '08 cycle, and you can just see how good things can be. And as I said, we're very early. It's a very, early in the cycle. Yes, stocks have had a great run, but, just look at it, if you want to look, just look at NVIDIA 3 years ago, you know, and say, yeah, it had a great one. The stock's doubled. Well, it more than multiples of that, since then. So I think that people should look at their favorite stocks, from a historic point of view and just see the run that they've had so far from 2020 to now, compare that to what happened in 99 '08, and they'll say, "Yeah, we're still very early in the business, and yes, we should take advantage of dips."
Excellent. Well, thank you so much, Joseph, for sharing your valuable insights with us. Please do let our audience know how they can read more of your material. And importantly, you mentioned to me that our audience can get a discount on your research. Please tell us how to access that.
Yeah, we try to, grow our subscriber base, and so when we do kinds of podcasts with new people in new markets, we offer a discount of $100 off. So when people go to subscribe on the website, when it gets at the end of it, the checkout, there'll be a promo code section and POD, podcast POD 100, and they'll get $100 off the 9.99 Canadian dollar price. And of course, the pound in Europe is more valuable than the Canadian dollar. The euro is more, so it's a bit of a deal. Um, what Go to www.schachter, SCHACHTR, energyreport.ca for Canada. And we have two products that we provide for people. One of them is our weekly macro piece called Ion Energy, which goes over everything that's going on between EIA data, OPEC data, what's going on with the Baker Hughes drilling data. And then we talk about our views, what's going on the geopolitics and how things are moving. So they get a macro piece every week. Twice a month, we do what's called the Schachter Energy Report, where we cover 32 companies. Right now, we're finishing the cycle of 2025 Q4 25 data. We're going through the NI 5101s. We're putting in the NAVs. We use flat pricing in our numbers versus the escalating and then discounted 10% because every engineering firm uses a different price deck. And so we'd rather use a flat price deck, which is more conservative from our point of view. And effectively, it's F&D cost numbers to create the barrel. We cover 32 companies. And I mentioned some of them have dividend yields of 4 to 6%. We break our research down into three groups: conservative. So we have a lot of older clients who want some dividend and want some capital gain. So we're looking at, 4, 6% dividend yield, 15% if you buy it at the right time, capital gain, be it royalty companies or high paying, oil and gas companies. Then we have the growth companies, those that even today have a growth wedge. And then entrepreneurial are the more aggressive companies that are willing to, go and the old drill baby drill, but hopefully the lie detector of the drill bit says, yeah, you found something. And if you have a successful drilling event, you can see your stock go up. One Canadian company that we watch was up 26% on Friday because they announced a very big success on their drill program. So that's the kind of thing where we try to give each of our audiences what they want. As I mentioned, we cover 32 companies. The team will be expanding our coverage this year because we've added some new personnel to our research team. And we think we might get up to 40 companies. We cover only Canadian companies, but Canadian companies that work around the world as well. We have Canadian companies drilling offshore Thailand. We have them working in Colombia. We have them working in Trinidad. We have them working in Brazil. Some working in Asia. So the Canadian companies come with the greatest technical skills that's available in North America, and they bring them into basins that are not doing horizontal drilling. They're not doing the perfing that are done the way they do now, not use of sand, all the kinds of things, longer horizontal wells, which were mainly not done in those countries. And so the Canadian companies are really doing a great job. And there's great opportunities, as I mentioned, depending upon your risk tolerance. I would say to people, if you're going to have X percentage weight, be it, there's large cap companies in Europe that you'd want to own. You may want to own some infrastructure with good dividend yields, but you want to also be involved in the international world. And Canada, of all of those places, is one of the best. So you may only want 1 or 2% of your portfolio in Canada, but there's a lot of great opportunities there. So that's where we provide independent research. And again, as mentioned, go to www.schachterenergyreport.ca, and at the checkout, take advantage of the discount.
Thank you so much. There'll be a great wealth of resource for our listeners there. Uh, well, thanks everyone for tuning in. We hope you've enjoyed today's episode of the Commodity Exchange. If you want to hear more from us at Wisdom Tree, please do subscribe to the Commodity Exchange in whichever podcast platform you're using. You can follow me on X, formerly Twitter, with the handle @Nitesh Shah WT, and on LinkedIn. If you want to learn more about commodities, please do visit Wisdom Tree's website, where we have a wide range of research material and insights. Until next time, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and Schachter Energy Report, and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results.